So we've always used the expression boring is beautiful to describe how we invest. But you actually have done some work on this more recently and come with really interesting numbers.
Yes, well, it wasn't really actually to discover that boring is beautiful. It was just to see, look, let's have a look at the stocks that have done the best over the last 20 to 30 years. So I did a screen and I filtered out any company that hadn't done 10% a year over the last 3 decades. The only thing I did was I said, if a company like NVIDIA had IPO'd 25 years ago, that would be allowable, and I just worked out the CAGR because I didn't want to exclude businesses like that.
Mm-hmm. That's fair.
Now, out of these, there are 500 businesses that have done 10% a year or more, and that 10% a year or more for 30 years is
extraordinary.
Is extraordinary.
Yeah.
Here's the thing, only 10% of them were tech or sort of sexy businesses. Only 10%. Now, if we then take that CAGR threshold from 10 to 20, so this is not just, brilliant. 20% over 30 years is tens, hundreds of thousands of percent total return. This is life-changing.
Yeah.
Only 15% of those stocks were tech. The majority were actually really dull, boring businesses. Businesses like NVR, the house builder, Intuitive Surgical, Ross Stores, Pool Corp, Domino's Pizza, Ashtead, which we own, and Games Workshop. These are all businesses that have, again, delivered tens of thousands, if in some cases hundreds of thousands of percent over 30 years. And I found this incredible. Because
it was very surprising.
Yes, you wouldn't have imagined it'd be that much.
Yeah.
I knew there were going to be a lot of them in there because we talk about these names, but to see when you look at the list, and
this is 5 and 6 are basically boring businesses.
Yeah, it makes it a lot easier to pick. Yeah. The trouble with picking tech businesses is that it's a moonshot. To try and pick that. Whereas a boring business, there's so much you can see about why they're great and why there's going to be longevity. But the trouble is, like we were discussing with fund managers, how fund managers go through long periods of underperformance, so too do these stocks. And in fact, in the lead up to the .com, 80% of these stocks, 80% of these boring stocks that have delivered superlative returns underperformed.
What's the number last year?
It was about 60.
So
getting close.
Yeah.
But and whilst the market was up that much in the .com, 60% of those brilliant businesses lost money, not just underperformed, but actually had negative performance. 60%. But what I find even more extraordinary, and we know this to be true because we remember it from the time, but when the market was down almost 40% in the following 2 years, the average stock of these brilliant businesses was up 35%.
That's a 70 percentage point difference in 2 years. Wow.
But again, I think this goes back to what we were saying earlier about capital being sucked out of these boring businesses. Yep. It goes into the sexy tech names. Everyone chases the hot new thing. And then as soon as that cracks, people rush back into safety. They rush back into the boring, safe businesses that they know and love and trust. And that's why when everything else is going down, they actually go up because these are businesses that that just generate cash flow and compound year in, year out. They have their hiccups. Almost none of these businesses has gone without 1 or 2 hiccups without a profit warning here or there. They've all had problems. But over the long run, what they've delivered is absolutely astounding.
Well, I think it highlights 2 things. I think the numbers highlight that long-term exceptional outcomes don't have to come from doing some exceptional thing. You can have something that looks mundane, but do it exceptionally well. And this is what those businesses have done. They've taken something that looks boring and mundane and just really execute and continue to execute good capital allocation time and time again and delivered exceptional returns over the long term. And then the other thing that I think this highlights is the importance of thinking about the long term. And you will have periods where you will have underperformance in some of these companies, actual losses, like you said, in years. Can you imagine owning one of these companies and selling it because it's gone down in 98, 99, just to miss out on an extraordinary return? I mean, and then trying to buy it later after it's gone up in price. It is just, yeah.
Is that not the challenge that we're facing now?
That's always the challenge facing any long-term investor. But I think at extreme cases like today, people like us have that challenge, sticking to a process that we know works over time.
Despite the pain.
Exactly. It is painful. It is no doubt painful to sit around owning wonderful businesses that do not go up in price when you know that they should. But we have to remember that over time this works, and only by sticking to a process does it work. And trying to move in and out of these names does not work. And yes, you end up with periods where you wish you're doing better, but you cannot time these things. And we know that every 20 years or so, we're going to have an extreme case. I mean, there is an element of timing it around someone's career that seems to be kind of consistent. You had it in the late 60s. Again, 25 years later, you have it in the late 90s. 25 years later, you're having it. It seems that the market participants have a short-term memory, and people retire or leave the industry. You have a new generation. They've not learned the lessons of the past, and this thing repeats. And in those extreme cases, luckily, seems to happen every 20 years or so, but in those extreme cases, it's extremely important to remember lessons from history like this one and make sure that you stick to your process. Because as you mentioned, you have a situation where in a very short period of time, in 99 it was less than 2 years, where you have the 70 percentage point divergence. And if you wanted to wait and try to get in at time, you'll just miss it.
So really the most important thing here is your temperament. So that being the case, how we sort of behave on a day-to-day basis is really important, that we can't get too despondent, we can't get too down. We have to be sort of very conscious of, how much pain us and our clients are suffering, but it's quite hard this must be a really hard balance to mix, especially for you, the portfolio manager.
Yeah, I mean, I think it's always, I'm someone who likes to please people. And so it's always a challenge for me to look someone in the eye and tell them that we've ended up with a disappointing outcome. But I think on the other hand, I think part of why people hire people like us and pay us is so that we can make these difficult decisions. And I think by thinking like business owners, by really looking at what we own, knowing what we own, looking at what the business is doing, it makes it easier to look through 2 or 3 year periods of disappointment, because we can see what the business is doing. We know the businesses are strong. We know it's working. We know if we owned it and there was no stock market and there was no stock price to look at, we know what the economic value being created by these businesses is. And we know that while in the short term stocks go all over the place over long periods of time, if you buy something that is good and you don't overpay, eventually the stock price will catch up. And I think this is where it is. And I think in many ways, at the end of 2024, kind of into this year, I've turned a lot more bullish than I have been in a very long time, at least vocally, being vocal about it. I do think this is one of the most exciting opportunities for fundamental investors, for investors in quality in a very, very long period of time. And I think it comes with short-term pain, or has come with short-term pain. But I really think we are near that point, or the cusp of things turning. And I think the next 5 years are going to be exceptional for not just for us, but people who do what we do.